Hey everyone, welcome back to the channel. We're going to be doing a weekly financial news roundup and also talk about what is to come next week. If you haven't already, make sure you like, comment, and share this video. Also subscribe to our channel and also join our free private Facebook group where we have close to 5,000 members. Now without further ado, let's jump into this week's recap. So first of all, the Federal Reserve has increased interest rate by 0.75%. Now, the 2 days meeting have ended last Wednesday with Powell announcing a 0.75% hike. This is largely expected by the market as we have discussed on last week's roundup. After the announcement, Dow Jones bounced 2% while Nasdaq went as high as 4%. Now, the market didn't just go up because the rate hike matched expectation. In the meeting, Powell answered some of the reporters' questions and he said some things that the investors and the market really liked. Number one, he said spending is cooling. So while this could mean recession, this definitely can also help with inflation pressure as well. Second is he expressed that a 2.5% federal rate is now back at the neutral rate, meaning it matches the long-term inflation expectation. This signals that potentially the future rate hikes are going to be much more spread out and slow moving forward. And lastly, he commented on the US economy strength. He said personally he does not think the US is in recession due to very strong labor market despite spending's cooling. Now personally, I'm not sure about the 2.5% being a neutral rate, at least for the next 2 years. I feel like it's probably going to be closer to a 3%. Personally, I expect a little bit more aggressive rate hike before we really cool down on that front, but we'll have to see moving forward. I do agree with that. Technically, we will be in recession as we talk about GDP number next, but it doesn't really matter as long as labor market conditions stay strong. A contraction in GDP can also make sense given the supply issue we're facing right now with the war in Ukraine and also the amount of growth that US had for the last 2 years. Now, what also this means for Canada is that now we are going to be about 1.2% behind in terms of how much rate hike US did versus what we did. So I do foresee us to match another 0.75 moving forward in the next hike, or maybe even another 1%. So if the next inflation number doesn't look nice, I do expect Canada to see a 0.75% or another 1% rate hike. Now next, let's discuss Canada and US GDP report. So the day after Powell's announcement, Canada and US GDP number came out. As expected, US shows a negative GDP number of a negative 0.9%. This is going to be a second consecutive quarter with negative GDP, which means US is officially in recession. However, even though the market moved lower initially, based on this report, it did rally at the end of the day. And it's really happening for two main reasons. Now, number one is because this negative GDP has been priced in initially. People were expecting this already. And number two is many experts still not convinced that US is in true recession, again, due to strong labor and solid spending. Now, if we look at historical data, since World War II, whenever GDP number hits second straight quarter of decline, S&P 500 actually gained an average of 1.3% over the next week. It goes up 80% of the time, while over the next month, for 60% of the time, stock continue to rise 0.8% on average. Like we said, this is again due to investor already anticipating the drop prior to number being released. Once this has been confirmed, uncertainty is removed and people feel more confident to invest based on known situations. On the other hand, for Canada, for May's GDP number, surprisingly, we did not contract but instead stalled at 0%. Analysts expected a drop of negative 0.2%. And looking at the advanced data, output in June is on track for a small increase of 0.1% for Canada. Now, in May, growth in service producing sector was offset by declines in goods producing sector, particularly construction and manufacturing. Advanced info shows that in June, construction and manufacturing have bounced back already. This kind of decline in goods producing sector and ramp up in service sector, it's in line with what we expect whenever there's these kind of inflation issue. This is called the handoff effect. It's when people no longer want to buy as much things, but instead they want to spend money on services. Now moving on, let's look at corporate earnings last week. There were some winners and losers, but overall a very positive trend. Lots of very important corporate earnings was released last week. Notable ones are that oil companies unsurprisingly reported record-breaking revenues across the board. Companies like Exxon reported to have earned $17.9 billion for quarter 2, which was 3 times compared to 1 year ago of what they were making in the same quarter. While Shell, the biggest oil company in Europe, reported record quarterly profit. On the other hand, on tech side, Microsoft and Google both reported a slight miss on their earnings, but stocks still jumped after hours due to the miss being not as bad as expected. I think Snapchat's abysmal report previously spooked investors, so this actual slight miss is a sign of relief. While on the other hand, Apple and Amazon did amazingly and beat expectation and provide a much stronger guidance moving forward despite challenging supply issues. I'm especially impressed with the way Tim Cook have guided Apple ever since taking over. Very strong performance and one of my favorite stocks. However, not everything was looking pretty. We do have massive losers, and one of the biggest losers would be Intel, an extreme miss on their earnings even though analysts have lowered it already previously. Now Intel is a company that a lot of clients do bring up to me when they're thinking about entering the market at a low point, because they have very attractive PE ratios. But my answer to them is always that I do not like this company. I also don't think it's a good investment because they're not a leader in any aspect of their own industry. In the last 6 months, because of the market drop, if you really want to enter in this field, I would much prefer look at things like AMD, Nvidia, and even maybe Taiwan Semiconductor, ASML. All those might be a better hold than Intel in my personal experience. Now, that being said, AMD and Nvidia, all those other companies have pumped quite a bit recently, so you do have to be very careful if you're choosing to enter at this time. Now, finally, Goldman Sachs have cut their earning outlook for China. According to a report on Thursday, Goldman Sachs slashes MSCI China stock index from 4% to 0%. China property market came under renewed pressure. It has been reported that there's a massive spike in homeowners stopping to pay their mortgage as a strike against a slumping property market. There were also pictures of people making a bank run. I don't know the validity of these kind of images or how much does it represent the overall economy picture, but there were such reports. Head of research for Asia Pacific at CBRE Group cited that it could take up to 5 years to recover from oversupply in China's smaller cities. And lastly, they said that governments cracked down on developers' high debt ratio, as we've seen previously with Evergrande, which led to their default. And also their current policy on COVID contributed to developers being cash strapped and extremely slow in finishing the development. Now finally, for next week, there are more important corporate earnings coming out. Thanks to Redditor Big Bear 83 for putting this chart together. He actually does this every week, so I just look at his chart and see what major companies are coming out with notable earnings. And also in terms of announcement and reports, the only notable numbers we should pay attention to would be US job openings and also unemployment. Those numbers, again, is going to bring volatility to the market. If job market continue to be extremely strong, I imagine it might actually bring down the market, because that might signal that growth is still plenty in the US, and it's a sign that government can be a little bit more aggressive with their rate hike should they want to. So actually, in my opinion, the best kind of number that would really rally the market is a lukewarm job opening and unemployment number. That is going to signal to investor that maybe number one, inflation is peaking, and number two is that there's not as much room for further aggressive rate hikes. Now, I hope you have liked this weekly roundup video. Again, this is a new format. Let me know in the comment down below, what do you think? I think I'm going to upload this every Sunday or Monday so that I give a quick recap before we move into next week. I still want to keep Tuesday every week for our more educational video where I dive deeper into different topics. And as always, if you haven't already, make sure you subscribe to our channel, click the bell button to get all the notifications in the future. Alright, this is Jacky. I hope you liked this week's roundup. I'll see you on the next video. Bye!